When you start incorporating your family banking system, it's very important that you have some type of loan criteria in place so that people understand the expectations before you start lending money. A lot of times people have horror stories of lending to family members, and the reason they have a bad experience is because there was no expectation or structure in place in the beginning. And so you want to make sure you have some type of loan criteria, and this is the one that my family's been using. And so this is our family banking loan criteria. Number one, first and foremost, is education. That has to be the biggest one. So if a family member comes to me and they say, hey, we want to borrow some money for a vehicle, I say that's wonderful. I make sure they have read Becoming Your Own Banker, and I run them an amortization schedule, usually just using some online software like mycalculators.com. You can run very easy to comprehend amortization schedule. And so one, they have an idea of why we have this family banking system in the first place by reading Becoming Your Own Banker. And then they understand what an amortization schedule actually looks like, and more importantly, the interest and how everything's calculated. So they understand what they're paying, because eventually we'd want them to do this for themselves. And so first and foremost is education. And next is character. I want to know, what is the relationship capital like, or the reputation with this family member that I'm lending to? Because the reality is there are probably certain family members or people outside your family banking system that you just would never and should never loan money to. I mean, there is a reason why commercial banks don't loan money to just everyone. And so you want to be a little bit careful and make sure that you have that relationship capital. And what I mean by that is there's actually communication and an understanding, and you trust that person. They have a good reputation. Next is liquidity. This is such a big one. So I want to see, how much do they have in cash value, straight cash, or bank deposits? Are they like one paycheck away from disaster? Because if that's the case, I'm probably not going to make the deal. Liquidity, to me, is one of the most important factors of this. And so you want to make sure that they actually have stuff in savings in case something doesn't go according to plan, because guess what? Life is quite the adventure, and it rarely goes according to plan. Next is I want to look at some type of cash flow or capacity. So what do their financials look like, and income? Basically, their ability to pay. And the reason that's important is because if they have no ability to pay, or there's no income, or they don't have any of this stuff tracking, the odds of them making the payments on time will go down. So you want to be careful they actually have the income and capacity to actually make the payment, which is going to be directly in line with the amortization schedule and whatever interest rate you're going to charge. Next is I want to see some form of collateral. This is going to be like pretty a normal circumstance that a lot of banks would look at. This is usually the first place they go is collateral, credit score, and then cash flow. So we're literally flipping this equation. I'm going to get to why we do that in just a minute. And so I typically like to see 10% down. You can come up with whatever percentage that you feel comfortable with, depending on the loan. It might be more, it might be less. But let's say a family member wants to finance a $50,000 vehicle with me. I'm going to require that they have $5,000 saved up. They put that down. I want to see if they have liquidity. I want to see if they have the cash flow to pay. But I'm going to make sure I educated them, and we actually have a relationship that's built off of trust. And then we're going to make that deal. And lastly, this one's totally optional, I really don't even care about this one, is their credit score. This is, to me, the least important one. The first five are much more important to me than the last one. But this is typically where a bank starts. If you don't have a certain credit score, they don't even talk to you. And so this is the exact opposite of what we're trying to build. And what we're building is a family banking system that is focused on relationships. Now, this is why my family has been brought together and our relationships have been strengthened, because there's more trust, there's more relationship capital, we have better reputations with each other, we have more liquidity. All these elements have helped bring our family together the last 9 years that we've been doing this. And as you know, one of the things that we teach is abundance in the 5 areas of life. And the most important thing in every one of those areas are the relationships with your money, with your family, all of those things. And so when we are looking at loaning money inside the family bank, we want to make sure that we're starting with education, character, liquidity. We want to start with the items that actually help us build relationships with our family, so we see them as people and not as a number. which is how banks view us currently. And so this is the criteria that has worked very well for our family. You might take this list and critique it a little bit to make it fit you and your unique relationships with your family. And if you'll follow these rules, most likely you will have a very easy, productive, efficient loan portfolio within the family. No one's going to get burned. You're going to have great relationships, and you're going to limit your exposure to the risk. And so make sure you're taking the time to do this appropriately and spend the time that you need to invest into the relationships with the family before you just start loaning money.